In this video, I would like to share 10 key critical characteristics of preferred stocks. Preferred stocks are a type of stocks that share the same characteristics with both common stocks and bonds. And so here are the key characteristics of preferred stocks. Number one, dividends. Preferred stocks actually pay fixed dividends, and they typically pay these dividends and are quite similar to bond interest payment. The kind of interest, the kind of dividend they pay is similar to what is obtainable, in bonds. Although in bonds they call it coupon. So these dividends are usually higher than those of common stocks, but are fixed and do not vary with the company's earning. Whether the company earns a higher amount or a smaller amount, the dividends, when it comes to preferred stocks, are fixed. It doesn't vary with whatever the company earns. And when it comes to dividend preference, preferred stockholders receive dividends before common shareholders. If a company decides to pay dividend, it must first of all pay outstanding preferred shareholders before the company will pay common stockholders. Number two, priority in assets. When it comes to liquidation, so in case a company is liquidated, preferred shareholders have a higher claim on company's assets than that of common shareholders, but they are still below bondholders or debenture holders. In other words, in case a company goes into liquidation, what happens here is that the company's entire assets will be sold, and the money realized will first of all be paid to bondholders, debenture holders, and then whatever remains will go to preferred shareholders. And if anything remains at the end of the day, then common shareholders would share in the remaining assets, in the remaining fund. Number three, voting rights. Preferred stockholders have limited or no voting rights. Preferred shareholders typically do not have voting rights, or if they have, it is very, very limited. This is in contrast to common stockholders who usually have voting rights when it comes to corporate matters that governs the company. They can vote on maybe the appointments of a director or a chairman or an auditor. So all those key decisions, preferred shareholders do not vote on those matters. Only common shareholders do, because common shareholders have voting rights and preferred shareholders have no voting rights. Number four, price stability. Preferred stocks are less volatile, compared to common stocks, partly due to the fixed dividend payments and the fact that they are often purchased for income rather than for capital appreciation. Usually, when it comes to preferred stock investing, the preferred stockholder generally, they buy because they want that regular income that comes as a result of fixed dividend rather than waiting for or banking on any form of capital appreciation. Number four, price stability. Price stability. I've discussed on price stability. I want to go to number five, callable futures. Preferred shareholders have what is called callability. Many preferred stockholders or many preferred stocks are callable, meaning the issuing company can buy back at a predetermined price after a certain date. Once these stocks are issued, the company can buy back those preferred shares, those preferred stocks at an earlier fixed or predetermined price, at a given point in time, after a certain predetermined date. This can limit the upside potential for investors if the stock is called when interest rate drops. Usually when interest rate drops, the value of preferred stocks will climb. And if interest rate drops, the value of preferred stocks, it's just a matter of an inverse relationship. Number 6, convertibility. You have convertible preferred stock. What does it mean? Some preferred stocks can be converted into a predetermined number of common shares. This feature provides the potential for capital appreciation if the company's common stocks performs well. In other words, a preferred stockholder may decide to convert his preferred share or preferred stock into common stocks if he or she believes that common stocks will then do better than preferred stocks in future. So that convertibility characteristics is always available to preferred stockholders. Number 7, cumulative versus non-cumulative. When we talk about, cumulative, preferred share being cumulative, if a company misses a dividend payment, cumulative preferred stock, accumulates the unpaid dividends, which must be paid out before any dividend can be paid to common shareholder. What it means here is that in the case of cumulative preferred share, if a company cannot pay dividends, let's say this particular financial year, in the next financial year, the dividend is carried over to the next year. And then, that is how it operates. There's that particular feature of the dividend being carried over to the next year. And then when preferred shareholders are paid, then whatsoever remains, common stockholders will be paid as well. So you equally have on the non-cumulative feature. Non-cumulative, preferred stocks do not accumulate missed dividends. And so if the company skip a dividend, those dividends are lost forever, almost like common stock. If the company cannot pay dividends in a given financial year, the company will not carry forward that dividends into the next year to be paid, in the next financial year. It is lost, it is missed forever, just like common stock, holding. Number 8, perpetuity. Perpetual existence is a very important characteristic of preferred stock. They often do not have maturity date, meaning they can exist indefinitely unless they are called by the company. This is a very important feature, important in the sense that just like bonds, when you talk about, bond holding, you own a bond until the bond matures, that it covers its maturity, period. In other words, if a bond is described as a 2-year bond, 3-year bond, 10-year bond, you are expected to hold your bonds until that maturity period, elapses. And same thing is not applicable to preferred stock, because preferred stock have no maturity period. Its existence is almost, it exists, all through, like, indefinitely, so to say. Number 9, interest rate sensitivity. Interest rate risk. Preferred stocks prices are sensitive to interest rate changes. When interest rates rise, the value of preferred stocks typically fall, and vice versa. When interest rate falls, the value of preferred stocks will do what? Would climb, will rise as a result. There's that inverse relationship between interest rates and the value of preferred stocks. Please subscribe to this channel and ring the notification bell and give me a thumbs up. Also drop your comments. That will go a long way in helping me in this particular endeavor to bring you content that will make you become a well-grounded, well-educated, knowledgeable investor. Number 10, credit rating, credit quality. Preferred stocks are often rated by credit rating agencies, just like bonds are rated. You have junk bonds, you have bonds, that are rated depending on how safe they are. So in the case of preferred stocks, this particular rating equally applies to preferred stocks. So their rating can impact their attractiveness to investors, particularly those seeking income with lower risk. So preferred stocks with a very good rating will attract more investors than the ones with a lower rating, because the better the rating, the lower the risk inherent in that particular stocks. So as a preferred stockholder, or you want to invest in this class of stock, these 10 critical features are very important for you to understand as an investor.